Welcome to It's the Economy. Financial markets have been in a state of churn for the past 6 months, and the Israeli attack on Iran has taken the uncertainty and the worries just one notch higher. Can this war, if it continues, push up crude prices and disrupt growth even further? And will India continue to be somewhat resilient to the turmoil, given the domestic drivers for our economy? I have with me a seasoned watcher of the Indian markets, watched it perhaps from the Gulf War itself, 1990. Hitendra Dave, CEO, HSBC India. Hitendra, you were there in 1990 in the markets?
No, not so. Not as old as I look in.
No. But still, if you can give some perspective to how we should look at this, should it be looked at as prolonged or... the previous Iranian last October was a brief one.
Well, clearly, I possess no expertise in understanding geopolitics and, how long this will go on. But perhaps if you see how this transmits into India and to broader financial markets, one is always through the sentiment channel, right? Historically, people have associated high oil prices as being negative for India because India imports 80-90% of its crude oil. It's also associated with broader financial market uncertainty. If, in a broader financial market uncertainty period, emerging market currencies, emerging market equities, they tend to be less attractive as such. But if you go a little deeper, if you, set aside the sentiment and set aside people have to react when they get up in the morning to crude at 75 or whatever. See, oil demand in India has been growing at about 3.5%. For the last 10 years plus. Economy has been growing at between 6.5% to 7.5%. So therefore, the oil intensity of GDP actually is coming down quite a bit. So its impact, higher oil prices in 2015 was very different to what it should be in 2025, and hopefully in 2035 it will be even less minimal. But sentiment has a very important role in financial markets. So if this particular situation that we have is long-lived, then obviously we will be. But overall, as you mentioned yourself, we don't get into the oil's contribution to CPI is low, etc. So I would think this should blow over quickly from a financial market perspective.
Yeah. No. Oil contribution to CPI will not be an issue because the government did not reduce prices for the CPI basket even when prices fell to $60. Right. So we don't have to adjust it higher for now. But, the inflation number came in a little lower than even low expectations, 2.8. And chances are that it could be 2.5 for the month of June because edible oil tariffs have been cut. So, there were expectations in the market after the last policy that the terminal rate will not be 5.5, but could go. Does that hope still remain?
See, I would put it like this. With the Reserve Bank having changed the stance to neutral, I think the bar for any further rate actions, either direction, is very, very high right now. It does look like if it had to move, it would move more lower than higher because neutral, as you can go either way. But the economic data that we are presented with, growth at around 6.4, 6.5, which is very good when you compare it to the rest of the world, but relatively disappointing relative to our aspirations as an economy and as a country. Inflation, as you mentioned, I think it's likely to undershoot RBI projections. But for RBI to take any further rate action, I think the bar is quite high. So it has to undershoot quite dramatically. It cannot undershoot by just 30, 40 basis points and RBI changes. So you will need to get month on month successive prints that force the MPC to think that this neutral, which gives them flexibility, they could use the flexibility. But as I said, the average for the year would need to be, let's say, 2.75 or something.
And
not just for the current spot prints or inflation prints, but also what you're projecting 12 months hence. You need to get to a point where the 12-month hence inflation projection at 5.5% policy rate makes the real rate look very high. That's what you need to get to.
Okay, no, that's not there. At the moment, a dipstick I did indicates that next month will be, or rather the June print, this print will be 2.5%, or some people are even putting it lower. So we undershoot the Reserve Bank's 2.9 forecast for the quarter, but not by much. It would be maybe by 20%.
I think the key is 12 months hence.
Yeah. And actually the governor made that very clear, and that's why he was moving to neutral. Okay, I'll come back to the growth in a bit. what have you made of this CRR cut? This is outside the RBI's DNA. We have seen them use CRR only incrementally. 1%, what is the message?
I think 2-3 messages here. I think one is the industry has always questioned this, right? I mean, you take 4% of my deposits on which I pay interest and I earn nothing at all. So to that extent, you can look at it as finally Reserve Bank of India has accepted the industry's demand a little bit. I think the second thing is, and we have seen in the last 5-6 months, I think there is a very strong belief in the MPC stroke RBI that rate cuts without liquidity don't really have the same, the same effect as the desired effect. So I think this is really reassuring deposit-taking teams, lending teams, as much as money market dealers and bond traders, etc., that don't worry, liquidity will be there, it will be abundant, we will always be soaking in liquidity for the foreseeable future. You now plan your deposit and lending activities and rates accordingly. So I would think this is largely about ensuring that there is a long-term commitment on the part of RBI so that the transmission, which is in early stages, doesn't fall off, especially if RBI is not able to, the dollar positions they have in the period in which CRR.
The tussle is when you say neutral, the yields actually went up. On the policy day, in spite of this massive double bazooka, yields went up from 6.2 to 6.3 almost, the 10-year. So in spite of it, you think transmission will happen because of the liquidity?
I think there are two markets. One is the bond market, and then is the much larger loan and deposit market. I think loan and deposit market will react. It always reacts slowly. See, it is by nature. It doesn't react to a rate cut and straight away start affecting. Unlike T-bill markets or bond markets or whatever. So there, I think as long as you keep liquidity abundant and you have the assurance of liquidity will be abundant even during the busy season and all that, I think you will find progressively lending rates come down, deposit rates come down. In any case, we are living in an era where a very large part of the bank loan market, bank assets are linked either to repo rate or to T-bills, right? So there the transmission has been quite remarkable.
Yes.
I mean, 100 basis points just in 6 months or so. And in the case of T-bills, even more than 100 basis points or so. So to the extent these rate cuts and liquidity injections were towards transmission, that I think will continue to happen. And each month it will continue to happen. On your point on why is the bond market not getting the message from RBI, they've got 50 basis points, which was more than almost everyone's expectation. They've got a CRR cut, which wasn't on anyone's agenda or radar at all. I think you just need, for some time, things to stabilize. I think this uncertainty and today, the opening question that you had on oil and Iran and Israel, I think doesn't really help. But my sense is, I think, as with the passage of some time, I think as RBI is able to clarify what exactly do they mean, what exactly should the market be projecting in terms of what happens if inflation undershoots and things of that nature. I think the market will really, I think it's trying to discover equilibrium today. Okay. So any help anybody can offer in helping discover that equilibrium will help.
Okay. What's your sense about FII and FDI, more particularly FPI in bonds? Do you think this gets disturbed? We saw a good flow and then it tapered for a month, I think.
No, see, I think if you're an FPI sitting in New York, London, Geneva, wherever in the world, I think the one common word everybody uses, I mean, you read MPC reports of many, many central banks, the most commonly used word is uncertainty.
Oh, that's true.
Okay, and if you're sitting so far away from a country and there is so much uncertainty, tariff was one, oil is one, geopolitics is another one, do you want to keep cash close to your chest? It's a natural reaction. I think many Indians are doing the same. So why would foreigners not behave differently? So I think as far as bond market is concerned, the key drivers, which is lower rates, abundant liquidity, frankly, zero supply, right? We are into the third month of the financial year. I think net of RBI OMOs and government buybacks and things like that, there is zero supply. So the underlying conditions of fixed income markets are very, very constructive as they've been in many, many years. I think you have to ignore what's happened in the last 3-4 days because the market will find a new equilibrium, the positions will get washed away, etc. And then you will see the next round lower is my sense.
Just give me a final word on what you make of the India story. You stand on the crossroads of FDI as well. Does it look like we will attract China plus one? Does it look like private capex will pick up?
See, China plus one, there is a logical reason for India to aspire to be the largest country that gets the supply chains and manufacturing located inside our country. The government has tried out quite a bit, right, through production-linked incentives and capital subsidies. So in certain sectors, you can see success. You can see it in phones, you can see it in semiconductors, you can see it even in some electronic products as well. At a broader level, I think people who are closer to this subject than I am do tell that the opportunity is there. Okay. But there is no God-given right we have that it will only come to us, because countries smaller than ours have ensured that the whole ecosystem, from land to people to electricity prices to logistics, yes, port transportation, tax at the ports, etc., everything has come together. We should not be wasting this opportunity. This whole development around US tariffs is I think every board around the world must be thinking which country should we go double down on, and we must do everything possible. I know the government, you can see lots of ministers traveling around the world, etc., but this is really for us to lose.
Okay. Let's see. We'll do our best. Thank you very much, Hitendra, and particularly for dropping into the studios.
My pleasure.
And this interesting conversation. We have to wind up on Bazaar. Chartbusters up.